So once again, good evening to all of you. In this subject, that is international finance, okay, we finished the first three chapter in the last sessions. Okay, so in the last sessions, we see that is the different types of what is meant by bonds and what are the different types of bonds that we seen in the last sessions. In last sessions, we see what is the bond, that is types of the loan agreement between the financial institutions, banks, and the companies. Okay, so how the companies raise the fund through the bonds. So there are some types of bonds we see, that is the foreign bonds, euro bonds, floating rate notes, uh, deep discount bonds, we can say the dual currency bonds, equity related bonds. Okay, we also see the how the companies issue the bonds into the international markets. So in this now in this sessions, we understand the we starts with the fourth chapter, and we are going to understand the uh, taxation systems and the legal aspects at the international levels. Okay, so how uh, the companies taxed by the nations, because we know that the international trade or the international business is the across the border business. That means it is the income generated by the one company into the geo of the another nations. Okay, so yeah, it might be the case that the same income tax by the two nations. Okay, so that's what we called as the double taxations on the international level. For example, if you take the we can say the Reliance is an Indian company. If they're doing their business in any foreign company, let's take example, if they Tata Motors sell their cars in South Africa. Okay, so the Indian company is generating the income in the geographical area of the South Africa. So now the big question arises in our mind, that which country is getting a tax, either South Africa or the government of India. So that is the big question. If the both the governments we can say tax the profit of the Tata Motors, then that we called as the double taxations. That means the same income, the same profit tax taxes by the both the nations. So this is the concept, or this is the confusion in the tax. So that we what we called as the international double taxations. Okay, when the income across the borders, we can say often faces the challenge being the taxes twice. Okay, the fundamental issue affects the millions of the taxpayers and the business operating internationally. So because of this double taxation, so that hinders the international trades. Okay, so that we can say uh, reduce the motivation of the businesses and the individual investors who doing the business on the international trades. Okay, so they get demotivated because of this double taxation. Okay, so uh, first we understand if you see the definition of international double taxation is given here, that is the taxation of the same income or the assets by two or more countries, creating the unfair burden on taxpayers and hindering the we can say international trade, international business, or the international economic activity. Okay, that means the same income by the company is taxed by the two nations. Okay, so one country says that it is the our resident business organization or the company, and the other country says that the income is generated in our geographical area. So that's because of this confusion. Okay, the same income of the company taxes twice. So, what is the root cause for the double taxation? That is, we can say that double taxation occurs due to the overlapping of the tax rate. That is, both the countries are claiming the tax. That is, we can say first one is we can say the residual uh, country, and the country where the income or the profit is generated by the business organizations. So, and because of that overlapping tax claims based upon the conflicting residual and the source principle, uh, where the multiple jurisdiction asserts their right to tax. Okay, now the big question is the which country is having the right to tax that generated income. Okay, so when they both the countries taxes the same income, then that is the double taxation. So how we can avoid the double taxation and reduce the burden on the taxpayers? So that is the big question. If you not reduce that double taxation, then we can say the businessmen demotivated to do a business on the international market or on the across the border trades. So uh, what is the we can say why the double taxation on the international level or the international market in the international business? Why there is a double taxations? Because we can say because of these two principles. First one is we can say the source principle, and next one is the we can say the resident principle. So source principle is we can say the taxing country claiming the right to tax income generated within its territorial border. As we take the example, if you get Tata Motors sells their cars in the South African region, that means they generate the income in the South African territorial regions. So that's why we call this as the source of income. And that's why the South Africa claims the tax, because the South Africa says that the income generated by the Tata Motors is at the our source in the our geographical area, and because of this that source can say country claims the tax. Okay, so and why what the justification given by that source country that if this says that the income is earned or generated in our geographical area, and because of that business profit and all these things. Okay, so that's why they claim the tax on that generated income. Next one is we can say the resident principle. So we all know that the Tata Motors is the India's resident company, and they're doing their business in the geographical area of the South Africa. So that's why the Indian government says that so Tata Motor is the our nation's company, and that's why uh, we are liable to get the tax from the generated income generated by the Tata Motors. So the taxing country claims that the right to tax the worldwide income of its resident company, resident organizations, regardless of where that income is generated. Okay, and why they claims based on the taxpayer resident status. Okay, so they gives the claim that that country is the our residents if the any individual we can say individually generating the income in outside India, and he is the citizen of India, and on that basis, then Indian government can claim the tax from that individual as well. And same likewise, the Indian government can claim the tax from the companies as well. Okay, so this is the because of this source principle and the resident principle, we can say the double taxations we seen on the international level. Okay, so here are some of the types of the double taxation. Okay, so first type of double taxation is the jurisdictional double taxation. That means when the same income tax by the multiple states or the multiple nations, more than one nations, so that's we called as the jurisdictional double taxation, because we can say the companies taxed by the two nation because of the conflicting interest. This first country claims that we liable to pay a get a tax, and the resident country is also claim that we are eligible to get the tax. So because of this we can say overlapping and the contradictory uh, conflicting interest, these jurisdictional double taxations will be there. Next one is the economical double taxations. We know that as a shareholders, whenever the company is generating the profit, okay, whenever they're generating the revenue, we minus the cost of goods sold, then we get the gross profit, then we minus the operating expenses, then we got the operating income, and then we minus tax, interest, and all these things, we get the net profit. So on that net profit, company has to pay the taxes. Okay, so the company pay the taxes to the governments, and when company distributes their profit to their shareholders, okay, in the form of, we can say, the dividends, again the government tax that dividend. Okay, then again government tax to that shareholders on the income of the dividends. Okay, so on the same profit, on the same income, the government tax at, we can say, twice. So that is also the double taxation. So these are the two types of the double taxation, that is the jurisdictional double taxations and the economic double taxations. Okay, so you can understand double taxation by some small video, so you can thoroughly understand the concept.
Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we have a topic in front of us that is double taxation. What exactly double taxation is all about? Let's try and understand this. See, as there's a dialog box over here, it shows some information. It says that when we pay income tax twice on the same source of on income or the assets or the financial transactions, then the taxation principle is known.
Wait just a second. Just me.
तो एक हाई पेइंग सैलरी के लिए, एक बहुत बड़े प्रमोशन के लिए आपको आना चाहिए एडवांस एक्सेल के साथ एआई और चैट जीपीटी का सही इस्तेमाल करना। लेकिन 10 में से 9 लोगों को पता ही नहीं है कि एडवांस एक्सेल के साथ एआई और चैट जीपीटी को कैसे यूज किया जाए। आपकी इस मुश्किल को आसान करने जा रहा हूं। मैं सिर्फ 3 घंटा आपसे मांग रहा हूं। इस 3 घंटे के अंदर मैं आपको एडवांस एक्सेल के फॉर्मूलाज के साथ एआई और चैट जीपीटी हैंड्स ऑन प्रैक्टिस के साथ सिखा दूंगा। इस स्किल को सीखने के बाद आप
Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we have a topic in front of us that is double taxation. What exactly double taxation is all about? Let's try and understand this. See, as there's a dialog box over here, it shows some information. It says that when we pay income tax twice on the same source of income, or the assets or the financial transactions, then the taxation principle is known as the double taxation principle, which is known as double taxation. So this taxation principle is, may be applied at both, the corporate level as well as at the personal level also. Again, when there is an international trade, then this tax is applied in two different countries. Like for example, corporate profits when earned are taxed as corporate tax and then taxed as the so-called personal income. So when it is distributed as dividend among the stockholders, and also in case of the owner of the organization who is also the employee of the organization, so they get taxed when he receives the salary. So again, if he receives the dividend from the company, being a shareholder, he needs to pay the tax on the personal taxes. Let's discuss the double taxation in corporation S corp and C corp, two corporations. The principle of taxation, it affects the C corp corporations where the business profits are taxed both at the corporate level and the personal level. And double taxation in corporation must pay income tax at a corporate level or the corporate rate even before distributing the profit to the shareholders. So then the profit shared between the shareholders as the dividend is taxed again at the recipient's individual rate. Thus, the corporate profits are taxed twice. So the double taxation in the corporation is not affected by the taxation principle. And a corporation which passes through the earning directly to the shareholder without going via the intermediate step of paying the dividends. Fourth, it is generally accepted, as a negative element of the tax system, and the tax authorities, they try and avoid it in the possible situation. So the taxation process, they puts the corporation at the disadvantage when compared to the unincorporated businesses. So that provides the incentive to corporations to use debt financing instead of equity financing, and then and retain earnings instead of distributing among the shareholders. Moreover, if corporates and personal tax systems, if they are integrated, then their tax code is simplified to to a large extent, you can say that. Now the tax results, when the divided when the dividend is given, how the things are going to get affected. See, the corporate level tax for the S corp, the taxable income is zero, but for C corp it's 2 million. So the marginal tax rate, that's the maximum marginal, is going to be 28%. Since it is zero, there'll be no tax that will be charged. But over here on 2 million, 28% is going to be 5 lakh 60. At the individual level, it's going to be the S corp, the company who's going to get charged. So 2 million into 35%, which is the marginal rate for S corp, and the tax is going to be 7 lakh. But over here, it's going to be zero. And the qualified dividend tax, 15%, zero in this case, but again, 15% will be charged to C Corp. So, how to avoid this kind of double taxation? See, there are several ways, for how to avoid the double taxation. First, the smaller double taxation in corporations, most of the major shareholders are, you can say, employees of the firm. And thus, the earnings are distributed among the shareholders as so-called wages, fringe benefits. So for how to avoid the double taxation, see, although the employee is liable to pay tax on their income, the corporate deducts the wage and the benefits paid as an expense of the company, and thus they avoid paying corporate taxes on the amount. Second, in case of the small business, the entire amount is distributed to the employees or the owner's account, and thus nothing is left which can be subjected to the corporate tax, right? And in situations when income is left with the business, it is done so for financing future growth of the company. Though this amounts come under the corporate tax, these taxes are usually lower than the rate paid by individuals. Fourth, there are large companies whose shareholders are not their employees, and the earnings or corporate profits cannot be distributed as wage or fringe benefits, are often able to avoid double taxation. So these employees can be shown as the tax consultant, and as the payment to the consultant come under the tax deductible business expense and dividend, and another dividend. So the shareholders in this situation still pay tax on the compensation. Six, it is also an option to add the shareholders to the payroll, as a member of the BOD, that's a board of director of the company. So there are some tax exempts, for the investors, such as like pension funds and charities, which are significant, they are shareholders in the large corporations. So these groups have the tax exempt status, which helps them to avoid paying taxes on their corporate dividends received. Now, what about the international double taxation? See, international business, if you see, they often face the issue of the taxation principle. Now, their income gets taxed in the country where it is earned, right? And then this income is again taxed when it is sent back to the business home country. So in many cases, the total tax rate becomes so high, making pursuing international business as an impossible and expensive venture. So to avoid this kind of situations, countries all over the world have made hundreds of double taxation treaties, just to avoid the double taxation, which is based on the model given by the OECD, which is your Organization for Economic Corporations and Development. So, mentioned in the Double Taxation Treaty by the signatory nations, they are the limit of the taxation of the international business to help in trade between the two countries to avoid double taxation. So, Indian position. What is exactly the India's position on the double taxation? See, India has comprehensive DTAA, that is the Double Taxation Avoidance Agreement, with closely with 88 countries, and of which 85 have already been put into action. So there are provisions in the Income Tax Act, which provides relief to the taxpayers, and it helps to avoid double taxation. So let us suppose that the interest on the NRI bank deposits attracts, let's say, 30%, right? So TDS in India. So since India has signatory double taxation treaty with 88 countries, so tax deducted may be 10 to 15% instead of 30%. Again, many foreign institutional investors who trade in Indian stock market, they are operating from Singapore to Mauritius. India has a signatory double taxation treaty with the Mauritius, following which the capital gains from the sale of the shares are taxable in the country of the residence only of the shareholder, and not in the country of the residence of the company whose shares have been actually been sold. So, company residing in Mauritius selling shares of the Indian company, they need not pay tax in India. And since there is no capital gains tax in Mauritius, the company avoids paying any other altogether. So, moreover, on a concluding end, in the large countries like India, where the product is transferred from one state to another, it is used to get taxed in various states, and this that they get rid of this problem with the government in India has introduced a thing called GST. But that's it for double taxation. So that's it for this particular topic. If you have learned and enjoyed watching this,
So this is all about the double taxation. So, okay, so that's we understand why the companies gets taxed by the two countries. Okay, because the one company is doing the business in the borders or the geographical area of the another country, and that's why there is confusion of the taxations, or we can say the conflicting interests between the two nations, and that's why there is the double taxations. Okay, so we can say now, where the income meets the conflicting, then and then there is the double taxations. Okay. Now, how we avoid that double taxations? Okay, what is the mechanism that regulate the double taxations? Okay, when the two countries, when they mutually decides, they mutually make the agreement that how the parts which country gets in the tax, and then only they can minimize the tax on that company or their organizations, and then they can motivate that company to do the business across the borders. Okay, if they settled their conflicting interest, okay, they settle that we can say the confusion of the tax between the two nations in the form of agreement. That means they agree on terms on some terms and conditions. Okay, and then by doing that agreements, okay, on a table, and then only we can avoid that double taxations. That is to the businesses, and then only we can say that companies and the organizations motivated to do a business on the international trade. Okay, if the company is losing all their profits, all their income in the tax only, okay, then company is not motivated, they get mm, demotivated, and then no company or organization is ready to do a business on the international levels. Okay, because we know that what is the main motive of the business? The main motive of the every business organization is to generate the revenue, to earn the profit. Okay, if there is a tax at a very high level on the international level, so why then company doing the business at the international level if there is obliged to pay that much high taxes? Okay, so if the countries mutually decides they when they agrees on some terms and conditions, and they put these agreements on a paper. Okay, when they agrees with this some of the terms and condition, that which country is getting how much percentage of the tax out of the generating revenue, then and then only we can avoid that double taxations. Okay, to avoid the double taxations, we can, the two countries have the double taxations agreements, that is the DTAs. Okay, by the bilateral treaties in between the countries, they can avoid the double taxations. And that is the, we can say, the comprehensive agreement between the two countries. That is, the two countries sit together, they make the agreements, and they allocate the taxing rights to eliminate the double taxation across the border of the incomes. Okay, so which country gets how much tax? Okay, which countries gets the how much rights for the taxations. Okay, so all these terms and conditions, they put this in on a paper in the agreement, and this is how they can avoid the double taxation. We can say the relief method. Okay, the common approaches include the exemption of the foreign incomes from the domestic tax and providing the tax credit. Okay, sometimes the relief methods, if the India wants the more foreign investments, and foreign investor to invest in India, so if we give the reliefs in a taxations, automatically the investors motivated to invest in the Indian regions. So because of some relief methods which implemented by the government, so this is how we can avoid the double taxations. Now some of the economic benefits, that these agreements between the two or more nations, that facilitate the cross-border trades and investment by providing the tax certainty and reducing the compliance burdens for the businesses. Okay, so if the some of the economic benefits provided by the countries to the businesses, business organizations, okay, so then we can avoid that double taxation. So by doing this type of agreements, this type of laws, the we can say the, we can avoid the double taxations on the international level. Okay, so the key provisions in the double taxation agreement is the resident definitions. Okay, so the clear criteria for determining the tax resident and the permanent establishment to avoid the conflict. Okay, so the clear criteria is defined in that agreement, that is the which part is taken by the source country, and which part is taken by the resident country. Okay, and next one is income allocation, the specific rule for dividends, interest, royalties, and the business profit and taxation rate. Okay, so all these criteria, that is means if the countries taking the tax on the profit, then they can give the reliefs in the dividend. Okay, because the profit is, we all know that the profit is the income of the shareholders itself. Okay, so the government levied tax on the profits as well as on the dividends, so it is an injustice, it is, we can say, it's a double taxation. So sometimes the government can form the specific rules for the dividend or the taxation for the profits. So this is how we can avoid the double taxations. Okay, so here in 1994 one case study is given to us, that is the US and France made the agreements to avoid the double taxations. Okay, so in that agreement they put the things that, so their companies can do the business in the another company. That means US company can do the business in France, and the France company can do a business in the US. So this is how they made the agreement, and by doing that agreement, they can avoid the double taxation, they can balance their conflicting interest. Okay, so
है ना, मैंने खूब पैसा कलेक्ट किया, मैं ह्यूमन ट्रैफिकिंग करता हूँ अभी इस समय पर, है ना, नार्को भी मैं बेचता हूँ इस समय पर, पूरा गांजा वांजा लेके घूमता हूँ। लीगल मनी, इलीगल मनी को मैंने ट्रांसफर किया हवाला के थ्रू मॉरिशस में। मॉरिशस में कंपनी खोली जिसका नाम था तुषांत यादव ड्रग डीलर कंपनी लिमिटेड। डबल टैक्स अवॉइडेंस एग्रीमेंट, ये तो अवॉइड करने के लिए है। मैं आपको समझाता हूं कैसे।
इसको प्यार से लोग बोलते हैं DT डबल ए। अब मैं समझाता हूँ कि इसमें होगा क्या, है ना। मैं बहुत ही प्यारा बच्चा IIT में पढ़ रहा था, मेरी USA में जॉब लगी। मैं दौड़ते 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 मतलब फ्लाइट से पहुंचा तो उन्होंने कहा कि $50,000 मिलेगा। मैंने कहा बढ़िया, दे दो। कहा कि उस पर 40% का टैक्स लगेगा। मैंने कहा ले लो। उसने ले लिया 20,000। 40% निकाल लीजिए भाई, 500 को 20 है ना, 40% 20,000 रुपीज आएगा। ठीक है, पक्का ना, आएगा, देख लेना। उसके बाद कितना बचा, $30,000 बचा। तो USA में गया, USA में एक्टिविटी की, एक्टिविटी करने के बाद इनको मैंने टैक्स भरा, और टैक्स भरने के पास मैं दौड़ के फिर से छोटे छोटे पैरों से फिर से घर पे आया, दौड़ के घर पे आया $30,000 लेके। तो सबसे पहले तो मुझे कन्वर्ट करना पड़ा। तो मान लीजिए 80 रुपए का एक्सचेंज रेट चल रहा है, $1 इक्वल टू 80 रुपीज। एक्सचेंज करा तो मुझको इतने लाख रुपए बने, कितने, 24 लाख रुपए बनेंगे। 24 लाख रुपीज पे मान लेते हैं कि इनकम टैक्स स्लैब का एक ही स्लैब है। एग्जाम्पल के तौर पर सिंप्लीफाई करने के लिए 25% आपको टैक्स पे करना है ना। कॉर्पोरेशन टैक्स याद कीजिए, हम मान लेते हैं कॉर्पोरेट था, कॉर्पोरेशन टैक्स कितना, 22% सेस प्लस सरचार्ज 25% का अप्रॉक्स पड़ जाता था। हम मान लेते हैं कि 25%, तो 24 लाख का 25% कितना होगा, अप्रॉक्स 6 लाख रुपीज। ये भी चला गया। हाथ में कितना बचा, 18 लाख रुपए। तो यहां भी टैक्स पे किया 6 लाख रुपए का, और वहां भी $20,000 का पे किया। तो अगर मैं कहूं कि टोटल टैक्स कितना पे कर दिया, तो वहां पर मैंने 16 लाख रुपीज, अगर $20,000 को आप एक्सचेंज करोगे तो 16 लाख रुपीज आएगा। 16 लाख वहां पर टैक्स पे किया, 6 लाख रुपए यहाँ पर टैक्स पे किया, 22 लाख रुपए टैक्स में पे किया। मिला कितना था, मिला था हमको $50,000। ये कितना होगा, 80 के हिसाब से 40 लाख रुपए। तो 40 लाख रुपीज में 22 लाख रुपीज का मैंने सिर्फ टैक्स का पैसा भरा है। 18 लाख रुपए मेरी इनकम है। कहने का मतलब यहाँ पर ये है कि मैंने 50% से भी ज्यादा टैक्स भरा है। मतलब जितना मैं कमा रहा हूं उसका आधे से ज्यादा कौन ले जा रहा है, ये दोनों टैक्स कलेक्ट करने वाले ले जा रहे हैं। उधर USA ले जा रहा था, इधर इंडिया ले जा रहा। तो मैंने कहा कि यार मुझको मिला था पैकेज कितना रुपए का, 40 लाख रुपए का, और अगर इंडिया में 18 लाख का ही मिलता है ना, या 18 के 24 लाख का मिल जाता तो भी बेहतर होता मेरे लिए। कम से कम इंडिया में रहता तो मैं कम से कम, और कम से कम यहीं रहकर काम करता, सुकून तो रहता, माँ बाप के पास रहता। इतनी दूर जाकर दोनों जगह टैक्स भरकर मुझे मिल क्या रहा है। तो सिंपल सी बात ये हो गई कि अगर यही मिल रहा है तो ये दोनों लोग गलत कर रहे हैं, तो फिर यहां से यहां लोग जाना नहीं चाहेंगे। तो हमने कहा कि डबल टैक्सेशन अवॉइडेंस एग्रीमेंट, ऐसा एग्रीमेंट साइन करते हैं कि इंडिया और USA, या तो तुम टैक्स लगा लो और हम नहीं लगाएंगे, या तो हम लगा लेते हैं तुम मत लगाना। डबल टैक्सेशन अवॉइडेंस एग्रीमेंट, यानी दोनों लोग एक ही इनकम पर टैक्स नहीं लगाएंगे। आपने टैक्स ले लिया, दोबारा टैक्स नहीं लगाया जाएगा। इसको हम बोलते हैं DT डबल ए। तो मान लीजिए इंडिया एंड USA, अगर ये दोनों DT डबल ए कर लिया, तो यहाँ पर अगर 40% टैक्स देना पड़ रहा है, तो अगर ये यहाँ पर आएगा तो नो टैक्स ऑन इनकम, इनकी इनकम पर कोई भी टैक्स नहीं लगेगा। समझ गए, डबल टैक्सेशन अवॉइडेंस एग्रीमेंट। ठीक है, अब कुछ और चीज समझते हैं। एक चीज समझते हैं, इसको हम यूज कैसे करते हैं, चालाकी से यूज करके दिखाता हूं मैं आपको। DT डबल ए तो आप समझ गए, अब इसी को एक ही जगह टैक्स लगेगा, ये भी बात आप समझ गए। इसको मैं टैक्स अवॉइड करने के लिए कैसे यूज करूंगा, देखो। मॉरिशस में कोई भी आदमी हो, कोई भी आदमी हो मॉरिशस में, अगर वो इंडिया के शेयर मार्केट में अपना पैसा इन्वेस्ट करेगा, लेट से तुषांत यादव कंपनी है जिसने शेयर्स इशू किए हैं, और ये आदमी मॉरिशस से उसने शेयर्स को बाय किया और फिर बेचेगा भी। तो मान लीजिए 100 करोड़ रुपए का बाय किया था, 120 करोड़ का बेच दिया, कितना का प्रॉफिट हुआ, कैपिटल गेन 20 करोड़ रुपए का। इन दोनों ने एग्रीमेंट साइन कर रखा है, इंडिया और मॉरिशस ने, कि DT डबल ए 1982 का बोला गया कि अगर कोई भी मॉरिशस पर्सन या कंपनी इंडिया में शेयर्स को खरीदती बेचती है, तो जितना भी प्रॉफिट होगा उस पर इंडियन गवर्नमेंट कैपिटल गेन टैक्स नहीं लगाएगी। कौन लगाएगा, मॉरिशस लगाएगा। तो मॉरिशस में कैपिटल गेन है 0 to 3%, बहुत कम, और इंडिया में है 10 to 15%। तो अगर इनको इंडिया में देना होता तो कितना लगता, 15% का, अगर लॉन्ग टर्म शॉर्ट टर्म उसके हिसाब से, है ना, शॉर्ट टर्म के लिए 15%, लॉन्ग टर्म के लिए 10%। तो मतलब कि इधर वाले जब इधर आएंगे तब इनको तो बड़ा कम देना पड़ेगा, यानी इनका प्रॉफिट का मार्जिन बढ़ेगा। मैंने सोचा कि ये तो बड़ी अच्छी बात हुई, तो मैंने सोचा कि अगर मुझे इंडिया में इतना ज्यादा देना पड़ रहा है मेरे पैसों पर, तो मेरे पास एक आदमी है जिसका नाम है हवाला, है ना। मैंने खूब पैसा कलेक्ट किया, मैं ह्यूमन ट्रैफिकिंग करता हूँ अभी इस समय पर, है ना। नार्को भी मैं बेचता हूँ इस समय पर, पूरा गांजा वांजा लेके घूमता हूँ और बेचता हूँ। अब उससे मेरे पास पैसा आया, इलीगल मनी। इलीगल मनी को मैंने ट्रांसफर किया हवाला के थ्रू मॉरिशस में। मॉरिशस में एक कंपनी खोली जिसका नाम था तुशांत यादव ड्रग डीलर कंपनी लिमिटेड अरे मजाक में बोल रहा हूँ, ऐसी कंपनी बना दिया। जो कंपनी कैसी थी? शेल कंपनी थी। आई होप यू नो व्हाट इज शेल कंपनी। दिस कंपनी विल डू नथिंग, नथिंग, कुछ नहीं करेगी। एक आदमी बैठा दूंगा जिसका नाम होगा छोटू। उस छोटू से कह दूंगा सिर्फ एक काम, कि ये जो मॉरिशस में सेल कंपनी है, छोटू जितना पैसा मैं तुमको भेजूं, यहां पर लाना, इंडिया के शेयर मार्केट में जिस कंपनी में चाहना उस कंपनी में पैसा लगाना, प्रॉफिट गेन करना और इनको जाकर 3% देना। और प्रॉफिट का मार्जिन ज्यादा होगा, क्योंकि यहाँ पर 15%, यहाँ पर 3%, कभी कभी तो 0% भी देना पड़ रहा है। तो अगर ऐसा है तो पूरा का पूरा मैंने क्या किया, 20 करोड़ का 20 करोड़ मिल गया मुझको यहाँ पर। और 20 करोड़ में अगर मैं थोड़ा बहुत हवाला को दे दूं, फिर से यहाँ पर बुला सकता हूँ, मंगा सकता हूँ, या राउंड ट्रिपिंग के थ्रू मैं अपनी ही शेयर इशू करके मैं फिर से वही काम करवा सकता हूँ। आई होप यू आर अंडरस्टैंडिंग द पॉइंट। यानी मैंने शेल कंपनी का यूज किया और क्या किया, टैक्स को इवेट कर दिया, है ना। मैं लाकर यही तो कर रहा हूं। तो टैक्स अवॉइडेंस, टैक्स इवेजन के पर्पज से क्या कर रहा हूं, मैं शेल कंपनी बना रहा हूं और DTAA का यूज कर रहा हूं, डबल टैक्सेशन अवॉइडेंस एग्रीमेंट। यानी भारत सरकार ने जो एग्रीमेंट किया है उसी का मैंने मिसयूज किया। कैसे? बस एक शेल कंपनी बनाई है और उसको पैसा भेजा है और उससे कहा है कि यहां पर तुम करो, और जो पैसा आएगा तुम्हारे पास, जाहिर सी बात है कैपिटल गेन का पैसा आएगा, तो उस पर तो मॉरिशस गवर्नमेंट को तो बड़ा कम कैपिटल गेन टैक्स देना है, तो मार्जिन तुम्हारे पास ही रहेगा। बात समझ गए? DTAA का शेल कंपनी। अब तो समझ आ रही है कि ये लोग क्यों ऐसा करते हैं। ये क्यों ऐसा करते हैं? क्योंकि इनकी इकोनॉमी में लोग क्यों आना चाहेंगे, है ना। इनकी कोई वाइबल इकोनॉमी नहीं है, तो इनके लोग मैं जाना चाहूंगा शेल कंपनी बनाने के लिए। बस एक ही काम है मेरे पास, पैसा लेके इनके पास इसी काम के लिए जाऊंगा और यहीं पर अपना पूरा बिजनेस जो है, एक्टिव बिजनेस नहीं, ये यहाँ से खरीदने का और यहाँ पर टैक्स को इवेट करने का बिजनेस करूंगा। ठीक है, ठीक है। और यहाँ पर तो मैं DTAA का यूज कर रहा हूँ, तो ये तो इलीगल है यहाँ से यहाँ पैसा भेजना। लेकिन यहाँ से यहाँ मैंने क्या किया, यहाँ से तो मैं टैक्स अवॉइड ही कर रहा हूँ एक तरह से, कि भाई जो भी है तो मुझको यहाँ पे करना, ये तो एग्रीमेंट में दिया हुआ है, मैंने क्या गलती की। लेकिन यहाँ वाला काम इलीगल है। समझ गए किस तरह से यूज कर रहे हैं, है ना। अच्छा फिगर बनाना है तो ये वाला बना लो, ताकि जिंदगी भर याद रहे आपको। ये वाला फिगर बना लो और एक काम और लिखवा दूंगा।
Okay, so when the two countries made the agreement to avoid the tax, so that's what we called as the that what we called as the
आएगा,
double
ठीक है,
tax
पक्का ना आएगा, देख।
agreement. Okay, so when the two countries made the agreement to avoid the double taxation, so that agreement we called as the double taxations avoidance agreement. That is the DTAA. That is the two countries we can say agrees on some terms and conditions. So here in video you see a example. So in that example, we understand that is how the India government and the Mauritius government agrees on the some terms. Okay, and by using this, we can say sometimes what company do, they misuse that DTAA, that is the double taxation avoidance agreement, and they takes the advantage of the rules, and sometimes the companies we can say evade the tax, okay, to gets the maximum monetary benefits. Okay, so tax evasion is a crime. Okay, so whenever the company is generating the profit, company is generating the revenue, and they are not paying the taxes. Okay, so if they evade the taxes, so it is the crime. Okay, so we can say, and as the international tax systems become the more sophisticated, to do the methods we used in the condemns the modern approaches required to the ND base. Okay, some of the uh, to avoid these things, that is the tax evasion. Okay, some of the steps the countries has to take So, what is the basic difference between the tax evasion and the tax avoidance? So, tax evasion is the illegal, we can say, a non-payment or the deliberately if the is not paying the tax to the government on their income. So, that is what we call as the tax evasion. Okay, so tax evasion is a, we can say, it is the intentional activity. It is, we can say, the deliberate underpayment of the tax if the company is not paying the actual tax on their income. If they are paying the under that means less taxes. And whenever the company is paying the less taxes or they are paying the zero taxes on the income or the assets, okay, so that's all we called as the tax evasion. And tax evasion is the we can say it is a crime in the view of the government. That means each and every individual business organization or the company who are generating the income that is obliged to pay the taxes to the government. Okay, so when they avoid or when they evade that, then that is that we call as the tax evasion. So the tax evasion is different and the tax avoidance in difference. Okay, so by using some legal proceedings on the legal rules, regulation, and the laws. Okay, if the companies or the individual who avoid the tax, okay, that's we called as the tax avoidance. Okay, so it is a legal but aggressive tax planning. That means the company is uh, plan very aggressively in such a type of investments, and they show their incomes, revenues, their expenses, their expenditures in the financial statements, and they show the little profit or the little income, or they show the more exemptions in the taxes, and this is how they save the tax. So the tax evasion is the illegal procedure, and tax avoidance we call this it is the legal procedures. Okay, and by using the legal we can say the tax avoidance method, the companies actually takes the advantage of the loopholes in the rules and laws. Okay, they exploit the loopholes in tax laws to minimize their tax. Okay, through it may be undermine the spirit of this tax legislation. Okay, so this is how the companies avoid the tax by using the legal proceedings, that is the rules, regulations of the country. Okay, so we can say uh, to preventing the treaty abuse, that means to prevent the advantage of the DTAA, that is the double taxation avoidance agreement. If the any company is taking the advantage of the DTA, how we can avoid that? We can say the so to avoid that there is the OECD approach. That is the principal purpose test is the first approach, that is denies the treaty benefits if the main purpose of the agreement is the tax avoidance rather than the genuine business activity. If the company is found that they are taking the advantage of and they are not fulfilling the basic principle of the tax avoidance, then the companies can be we can say we can the government can penalty to such a organizations. Okay, so these are some preventing approach, and how we can avoid the tax evasion by closing the loopholes in the laws, in the tax laws, in the rules, regulations, in the DTAA agreements. Okay, if we avoid these loopholes and enhance the transparency in the laws, then actually we can avoid the tax evasions. Okay, so first we understand what is the tax evasion. Okay, by some small video, and then we understand the basic difference between the tax evasion and the tax avoidance.
Evasion. Tax evasion is the unlawful non-payment or underpayment of tax by individuals, companies, and other entities. If a person or company evades taxes, they risk being in trouble with the tax authorities. When we hear the term tax evasion, we generally assume that the person or business deliberately did not pay tax. However, tax evasion can also include any illegal non-payment of tax, regardless of the entity's intentions. Every country in the world has a tax evasion problem. It's a global phenomenon. For taxpayers, tax evasion is unfair because the government has to make up for the missing revenue by taxing the rest of the population more. It is also unfair because the tax evader uses the infrastructure and services which was paid for with taxpayer money without contributing towards it. According to UK tax campaigner Richard Murphy, total global tax evasion is estimated to amount to 5% of the global economy. The difference between tax evasion and tax avoidance. Tax evasion is illegal and contrasts with tax avoidance, which is legal. Tax avoidance means finding all the legal loopholes and taking advantage of them in order to pay as little tax as possible. A good accountant can help his or her clients avoid paying tax. The difference between tax avoidance and tax evasion is that the former is legal while the latter is not. People who have earned money from criminal activity frequently engage in tax evasion, partly because they cannot report their true income and how they earned that income to the tax authorities. If they did report their income and where it came from, they would probably be arrested. Criminals who try to report those earnings as coming from lawful activities also risk being charged with money laundering. Thank you for watching this Markets Business News video on tax evasion.
Money disappear from sight in the form of taxation isn't something that always sits well with most of us. As a result, some people will go to
In this video, we greatly understand what is the basic difference between the tax evasion and tax avoidance. Okay, so tax evasion is illegal activity, and tax avoidance we can say it is the little but we can say a legal activity. Okay, it is all the things in tax avoidance we do in the which is suitable for the laws, suitable for the rules regulations, and by doing the aggressive financial planning, we can say avoid the tax. But tax evasion is the we can say a crime in the government's view. Okay, so patiently listen to the video, we'll understand what is the basic difference between tax evasion and tax.
sight in the form of taxation isn't something that always sits well with most of us. As a result, some people will go to great lengths to reduce their tax bill and, in some extreme cases, try to avoid paying tax altogether. Today, we're looking at the conflicting subject of tax evasion versus tax avoidance. In this video, we will cover the difference between tax avoidance and tax evasion, what is a tax avoidance scheme and should you use one? And finally, tax evasion. What could happen if you evade paying what you owe? Now, before we get started, be sure to hit that subscribe button as well as a notification bell to make sure you're kept up to date with all of our latest content. This really helps us to create more helpful videos and to get you free quality advice from real qualified accountants. In simple terms, tax avoidance is legally arranging your tax affairs to ensure only the minimum amount of tax is paid. Tax avoidance works within the letter of the law and takes many different forms. As an example, some of the most simple forms that you as a taxpayer have access to include holding assets such as shares in your spouse's name to make use of their capital gains tax allowances, selling off assets before the end of the tax year to make use of unused allowances, holding cash savings in an ISA so that any interest generated is free from taxation, and finally, using tax relief such as entrepreneurs relief, now known as business asset disposal relief, to pay less capital gains tax legitimately. These examples are very common and, as the majority of you have access to these avoidance measures, they tend to be looked at as sensible tax planning and are perfectly legal. Now, there are also tax avoidance schemes, which we'll talk about later on in the video, which, despite being technically legal, can still be challenged by HMRC through what is known as GAAR, the General Anti-Abuse Rule, which was introduced in the Finance Act of 2013. Tax evasion, on the other hand, also described as tax fraud, is illegal and could end up resulting in the criminal act of paying less tax than is legally due. Examples of tax evasion could include understating income or overstating expenses deliberately, or the complete omission of income or other information to HMRC. Now, just before we continue with today's video, we are thrilled to be launching the Accounting and Tax Academy membership site in April 2020. You won't find anywhere else. And the best part is, it's to register your interest in schemes aimed at individuals or tax avoidance schemes aimed at individuals or businesses with the sole purpose of paying less tax. Now, let's be clear here. General tax avoidance, that's sensible tax planning, and abusive and artificial tax avoidance schemes can be looked upon as two separate things. Although these tax avoidance schemes do their best to stay within the letter of the law, they are usually manipulating the law in a way that was not intended to be possible. The GAAR, or General Anti-Abuse Rule, aims to counter these artificial or abusive tax avoidance schemes. If you are taking part in a tax avoidance scheme, you are expected to disclose the details of the scheme to HMRC, normally through your self-assessment tax return. If you do not disclose the use of a scheme and are later found to have been taking part, then you could be subject to harsher penalties. HMRC defines a tax avoidance scheme in the following way. A tax avoidance scheme involves bending the rules of the tax system to gain a tax advantage that Parliament never intended. It often involves contrived, artificial transactions that serve little or no purpose other than to produce this advantage. It involves operating within the letter but not the spirit of the law. So, should you use a tax avoidance scheme? Well, in order to answer this, you need to make an informed decision. HMRC maintain a list of known tax avoidance schemes on their website under their Spotlight section. Click on the link in the description box below to go and have a look at some of these. If you are approached by a third party or discover a tax avoidance scheme, it's always advisable to read HMRC's view on it under the Spotlight section. Even if the scheme is not listed on the HMRC website, they will expect you to disclose the details to them if you have entered into and participated in the scheme. Now, it's not to suggest that all tax avoidance schemes are out of the question, as sometimes there is a very fine line between avoidance schemes and those HMRC would claim as abusive under GAAR. We suggest you follow these 4 general rules to reduce your risk of being caught up in an artificial or abusive tax avoidance scheme. Number 1. If the promoter of the scheme insists it's HMRC approved, then be suspicious. HMRC never approves any schemes. Check out HMRC's Spotlight, and if the scheme is listed on their website, then you should make your own informed judgment. Number 2. If the promoter suggests you don't have to declare the scheme, even if it's not listed on HMRC's Spotlight section, again, be suspicious. Perhaps this would be the opportunity to get a second opinion from a professional advisor, such as an independent accountant or tax advisor. Number 3. Round in circles. Where the aim is to move your money round in a circle with it ending up back where it started, this can also be an indicator of a tax avoidance scheme. And finally, number 4. If it sounds too good to be true. Spotlight 33, contractor loan schemes, was such an example where promoters were promising that a contractor could take home 90% of their income. Many contractors unfortunately fell for this and happily received up to 90% of their income as take-home pay. Eventually, HMRC caught up with this scheme and clamped down on it, including recovering retrospective taxes from thousands of contractors who had used the scheme, which was quite a sting. If you're in doubt or believe you are currently in or have historically entered into an abusive tax avoidance scheme and need further help, we always suggest you seek an independent professional opinion from a qualified accountant or tax advisor. Tax evasion, if proven, can have serious consequences. HMRC have a fraud investigation service, the FIS, a department that employs over 4,000 people. But firstly, it has to be investigated, and for civil cases, HMRC operate under the following areas: Code of Practice 9 and Code of Practice 8. Click on the link in the description box below to download HMRC's version of each. Don't forget, it's not down to HMRC to decide whether a tax fraud case is criminally prosecuted. HMRC's job is to make the case for prosecution through their powers of investigation, and the decision itself is made by the Crown Prosecution Service in England and Wales, or the equivalent authority in Scotland and Northern Ireland. In other words, you could end up in court and face a jury. I hope this video has helped you learn some of the
So this is all about the double taxations, and we can say the tax evasion and tax avoidance, and the basic difference between the tax evasion and tax avoidance that we understand in these sessions. Okay, so we sum up the sessions here. Okay, so we will meet in the tomorrow morning. Thank you. Thank you, guys. You can leave the sessions now. Please end the session.